All right, let's get right into it. When we look ahead to 2026, it's not just one single story. It's really two powerful opposing forces on a collision course. On one hand, you've got incredible technological promise, and on the other, immense real-world pressure. Let's break down what that means. So what are these two forces? Well, in the promise corner, you have this massive wave of AI investment, what some are calling the AI supercycle. It's fueling tech that can scale at an unbelievable rate, and it's happening alongside what looks like pretty sturdy economic growth. But on the other side, in the pressure corner, we're facing some serious headwinds. Looming power shortages, huge walls of debt about to come due, and a world that feels like it's fracturing more every day. These two forces, they're shaping absolutely everything. So, what does this clash mean for the global economy? Well, if you just glance at the surface, things look surprisingly resilient. But that resilience? It's fragile. The very foundation of our global economic system, yeah, it's starting to show some serious cracks. And this quote right here it nails the core problem. Think about it. The systems that used to protect us from shocks, things like abundant energy, cheap global labor, central banks with lots of room to maneuver, those shock absorbers are wearing out. In their place, we're getting bottlenecks and friction where there used to be a smooth, easy path. And you can see the result of that friction right here. We're looking at a world of divergent growth. The US is projected to be a major outlier, growing at a much healthier clip than, say, the Eurozone or the UK. Meanwhile, China's growth is settling into a new, slower reality. This isn't some synchronized global recovery. It's looking more like every region for itself. Okay, now let's talk about the biggest promise theme of them all, artificial intelligence. There is a full-blown digital gold rush happening right now. But here's the twist. It's running straight into a very real, very physical wall. And the scale of this is it's staggering. By 2026, global spending on AI is forecast to soar past $2 trillion. That is an unbelievable amount of fuel being poured onto this technological fire. But here's the catch, right? All of that digital magic, all those complex models and massive data centers, they don't run on hype. They run on electricity, an absolutely immense amount of it. And boom, here's that physical wall we were talking about. In the US alone, data centers are going to need about 44 gigawatts of new power. The problem? The grid is only expected to add about 25. That 19 gigawatt gap is huge. It literally means billions of dollars of cutting-edge hardware could just be sitting in a warehouse, idle and unpowered. And it's not just about generating the power. It's also about the raw materials you need to build the tech. You see, the AI boom is completely dependent on critical minerals. And as you can see here, the supply chains for these minerals are dangerously concentrated. China, for instance, controls 98% of the world's gallium. The potential to weaponize these supply chains is one of the biggest risks for 2026. Okay, so we've covered the physical pressures. Now let's switch gears to the financial ones, because there's a kind of hidden cliff that the commercial real estate sector is speeding towards. And here is the number that should really get your attention, $1.5 trillion. That's how much commercial real estate debt is set to mature, meaning it has to be paid back or refinanced by the end of 2026. This whole situation is what's known as a maturity wall. It's a simple but really dangerous concept. You've got this huge mountain of debt that all comes due at roughly the same time. This forces all these borrowers to scramble for new loans in what could be a really, really unfavorable market. So you can see how this quickly becomes a chain reaction. The loans mature, property owners have to refinance, but at much higher interest rates than before. And this is happening at the exact same time that the value of their buildings has fallen. That's a recipe for defaults, which then puts enormous pressure on the smaller, regional banks that hold so much of this debt. And as if all that wasn't enough, we have to layer the geopolitical landscape on top of everything. These global conflicts, they're not happening in a vacuum. They're acting like risk multipliers, essentially adding fuel to a fire that's already starting to smolder. The world is just dealing with so many shocks at once. You've got tensions over Taiwan ratcheting up, which threatens the entire global chip supply. The war in Ukraine is heading into a new, decisive, and frankly dangerous phase. And then actions, like a US blockade on Venezuelan oil, create this constant instability under energy prices. It's a lot, all at once. So after hearing all that, you're probably asking, what does this all mean for investors? Well, the key takeaway is pretty simple. The old playbook, it's obsolete. Navigating this new world of promise versus pressure, it's going to require a completely new way of thinking. Let's just look at this paradigm shift. The old playbook on the left was written for a world of low inflation and seamless globalization. You could just passively buy an index fund and do pretty well. But the new playbook for the world we're in now, it demands active stock selection, a focus on real assets and infrastructure, and the skill to navigate a much more fragmented world. So what does this actually look like in practice? Well, it means looking beyond just the obvious AI software companies and investing in the picks and shovels of the AI gold rush, the companies providing power, cooling, and all that physical infrastructure. It means prioritizing real, tangible assets that can hold their value when things get volatile. And it really requires a global perspective, actively seeking out markets that are better insulated from all these pressures. So you see, the challenge of 2026 isn't just about finding the next big opportunity. It's about stress testing that opportunity. Is it built on solid ground, or is it going to crumble under all this pressure? The real question you have to ask yourself is, are you prepared for that pressure test?